I think probably the most important single piece of advice is, even when you're very new, even when you're just starting out, and the idea of being on a stock exchange, any stock exchange, may seem very distant. Try to think of yourself, of your company and your business through the eyes of potential investors. So the important things, I think, are to have, or to put together, and you won't be able to do this from day one, but to put together, to assemble a really strong, credible, committed, and capable management team, to have in place just the basic sort of good housekeeping structures that a company should have. So in terms, when companies are starting out, often things have to get done very quickly, and that's fine. You do what you need to do. But as and when it becomes possible, to try and put in place sort of good housekeeping structures. So things like contracts with your people, contracts with your suppliers, or contracts with your customers. Try and make sure that when the day comes, as we hope it does, that you are going to go public, and people then come into your company and they will scrutinize everything about it in a surprising amount of detail. When they start opening all the cupboard doors and rolling up the carpets and lifting up the drain covers, that there's nothing too bad to be found. You won't be perfect, but if you can try and keep the place as clean and tidy corporately as possible while you're going through the growth phase, that's great. Now, these are counsels of perfection. It may be possible, it may not be possible, but bear it in mind, because having things in good order all the way through is a heck of a lot easier than having things in a terrible mess. You may have a fabulous business and a great opportunity, but if things like I just mentioned, you don't have a CFO, you don't have good contracts in place, you haven't filed your relevant regulatory or financial disclosures on time, tax returns, you haven't paid the rent on the office or the factory, stuff like that, it's a lot harder to put right than it is to try and keep it right all the way through. I'm very glad you asked. I really am. SPAC's got a lot of attention over the last 12 months or so, mostly in New York, but in some other markets as well. A CPC is a capital pool company. Conceptually is very similar to a SPAC. What it does and the way it does it is quite similar to a SPAC. The big differences are, number one, CPCs have been going for about 35 years in Canada. They're extremely well understood. They're extremely popular. It is the single most widely used way of going public on the TSX Venture Exchange. More companies use CPCs than do anything else, like a regular IPO or a reverse takeover. CPCs is kind of the normal way of doing things. So it's extremely well understood. Its focus really is on smaller companies. The SPACs, certainly, that have got a lot of attention in the New York markets lately, there've been these big ticket things, multi-billion-dollar valuations, Jennifer Lopez as a CEO. I don't know. It's been a very kind of high-profile, glitzy thing. Like CPCs are much more, I would say, almost like bread and butter. Every day of every week, there are new CPCs being formed and CPCs doing the thing that they're supposed to do, which we call a qualifying transaction, which is when a CPC merges with an operating business to become a listed company. And so a CPC, as I say, conceptually, it's like a SPAC. It's an empty shell that gets listed when, at the time of listing, it has effectively, its assets will be a little bit of money in the bank. It's rare that it's a very large amount. It's usually $1 million or $2 million. So it has a bit of money in the bank. It'll have a couple of directors, and it has a listing. Those are its assets. It has no liabilities. Well, it has shareholder funds, but it has no operations. It has no income. It has no costs. It has to pay the Toronto TSX Venture Exchange listing fee every year, but that's all. No one draws salaries. Its sole job is to find an operating business with which to merge, which will then become a listed company. It works really well. I think the fact that I think it's 2,700 and something of these things have taken place over the decades. It works really well. People continue to use it. They like to use it. There are a couple of reasons. If you're running a company and you're thinking of going public on the venture exchange in Toronto, using a CPC to do it will save you some time. It will save you some risk. There's a bit more certainty around pricing. It will save you some work. It's still quite a lot of work to become a public company, but if you merge with a CPC in one of these qualifying transactions, the CPC guys will do quite a lot of that work. That's their job. That's why they get paid, and they do get paid. So it takes some of the overhead off you. It reduces the time, and it increases the certainty. I always say that if you want to do a regular IPO, of course you can, or the alternative is to do a CPC transaction. The CPC will save you some time and save you some money, and you'll pay with a little bit of equity. If you do a regular IPO, it will take you longer, and it will cost you more cash, but you won't pay in equity. Now, these are decisions that have got to be made by the company's shareholder, the company's existing shareholders. What's the best way? Sometimes if there's a window in the market, as there seems to be at the moment, then actually getting it done more quickly and with a bit more certainty might be the right thing to do, even if it costs you, well, as I say, you will reward the CPC with some shares in the company, and that's, they're not doing it for love. So I think that's fair enough. And recently, last year, because CPCs have been around for a long time, the rules have kind of got a bit gnarly and encrusted with accretion over the years. So the rules were reviewed, cleaned up, tidied up, and the new rules went into effect in January this year. The changes aren't huge. It's been made slightly more flexible. It's been made slightly more attractive for CPC founders from outside of Canada. So we've tried to make it, because it's such a useful tool, we've tried to make it a bit more available to people from outside of Canada. And we're starting to see take up in places like Israel and in other international markets. People are starting CPCs from outside Canada because it can be a useful tool. So I think it's a fabulous tool. And it's mostly for smaller companies, and it is mostly for smaller companies, but it depends how you define small, doesn't it? I mean, on the 6th of May this year, a UK company went public via a CPC on the TSX Venture Exchange, a company called Small Pharma, a psychedelics business. It's a British company, and they did a CPC qualifying transaction, or they became the QC, and they raised $58 million. So that's at the larger end of what typical CPC transactions look like. There are lots of examples of companies doing it who will raise 5 million or 10 million or 15 million, but it's not that, it's not micro cap. A company can raise $58 million. That's significant.